Hello everyone, today is January 4th and this is excitingly the first session of the Wyckoff Trading course, part 2, the practicum. Welcome back all of the students, graduates of WTC 1. Welcome back also the alumni of WTC 2. Really happy to see you here, and for our guests, welcome as well. So let's go through the administrative issues first. For those of you who are new to our universe, or you guys maybe heard about us, been on our Twitter, been on our YouTube channel, watched some videos, maybe attended a session or two like this, Open Door, the first class, and you're here just to get the knowledge today, maybe exercise together with us, and consider signing up for our products. I just want to right away tell you that even though this is an open door class, the only way that you could get into it is by going through the WTC 1 course. WTC 1 course is the prerequisite to WTC 2 course, the practicum, and in WTC 1 course, this is where we are going deeply into the knowledge of the Wyckoff method, and I'm introducing to a lot of market structural ideas, price and volume ideas, relative and comparative analysis ideas, trading plan, trading tactics, and so on and so forth. So it's going to be essential for you to take WTC 1 course before you actually sign up for WTC 2. But today, please enjoy. We are so happy that you're here, and I'm looking forward to working with you. For those of you who are considering signing up, I just want to mention one thing, is that we have a payment plan, which is the 3 recurring payments of $333. This is probably the best, my favorite option right now, for the payments. And I just wanted to mention this, and I hope this is catching your attention. So 15 sessions each Tuesday at 3 p.m. Pacific. Homeworks, you guys already know how to do this, and what I want: one file, please, either in a PowerPoint, PDF, or Word doc. Those are the 3 formats that work the best for me. And absolutely one file. In the title, please include your first name. If you'd like, add, the first letter of your last name. The name of the class is important because, as you guys know, we have quite a few live classes, and our emails are being filtered as we receive them. So it's crucial for you to put in the title of your homework file the name of the class as well. And obviously our email, wyckofassociates@gmail.com. For those of you who are new, this is going to be probably interesting to know that all of our classes are interactive, and very often, either I'm asking questions and students are answering those in the questions box, and you can do this today, or for those of you who would like to step in, and sometimes we'll do those type of exercises where I'm going to ask for a volunteer, then you would have to have a headset with the built-in microphone. Now, all of the recordings and slides, as usual, as you guys know, are going to be stored on our website behind the password-protected page. All of the videos, all of the slides, and all of the homework assignments as well. And there will be homework assignments as usual, as we do in WTC 1 class as well. There is no way that these classes will not have homeworks. As usual, everything that we discuss in these classes is for educational purposes only, so please stop the recording and read it, the disclaimer in full. Let's go really quickly through the curriculum of WTC 2, the practicum. So basically, we are going to concentrate on drills and exercises. This is going to be an every week event for us, and this is going to be an every week homework. What I've realized teaching this material for now over 10 years, and being a Wyckoffian and studying the Wyckoff method for over 25 now, and trading it, and using the Wyckoff analysis and calling the market with Wyckoff analysis is that when people come to us and they acquire knowledge, and then they go and start trading, that knowledge, even though you have received it, might not be fully absorbed. So that's my point number one. Secondly, even if you have knowledge, and I always tell my students this, knowledge is not a skill. So even if you have the knowledge, it doesn't mean that you have the skill to recognize this knowledge on the chart. And the main purpose of the practicum classes, of the WTC 2 classes, is to build that skill of recognition. You have to be able to look at the chart and through your observations to make the correct deductions about what is going on in the chart and what are different market participants doing at the specific structural spots. And this is exactly what this class is about. We also obviously will be applying the knowledge. Our concentration will be on the bias and timing, but also on the character as well. So we'll talk a lot about that. We'll talk a lot about the trading tactics and management, developing different price structural scenarios. We'll talk about how we manage the risk, how we actually manage the trade itself. We'll talk about the filtering of our trade candidates before we get into the positions. And then, obviously, there will be a lot of advanced knowledge that I'm going to give you, the knowledge that is beyond the WTC1 basic and intermediate knowledge. This is where we'll talk about different phase behaviors, different variations on volume signatures, different behaviors of the trends. We'll talk about the modern technical analysis tools in combination with the Wyckoff methodology. And this is a very interesting topic for our students. I also will introduce you to my proprietary significant bar analysis. This has become a very big body of knowledge for us, where we look at the specific bars of significance and how they tell us the story of the environment where the price is right now, whether it's a trending environment or non-trending environment, and how we could utilize that to identify the beginning and the end of the swing, the aggression of the force behind it, possible continuation, possible tests, possible breakouts, and so on and so forth. So quite an interesting topic, and we're doing a lot of mechanization around the significant bars right now with students, so it's going to be very exciting just to continue this work. All right, so what are we going to do during this session? I think this is not updated slide. I apologize for that, but we're just going through the introductions. We're definitely going to do the market update as usual. So all of our classes, live classes, have that. We'll talk about and we'll do the first exercise on observations and deductions. And this is a fun exercise for all of us to do. It's going to bring up, a couple of main points for this initial introductory session. And then we will do the bias games. So this is what I have not updated. So the bias game reviews, we're going to have, I think, like 3 or 4 of the latest bias games that came after we adjourned our fall semester and went on the holidays. So we are going to go through those. It's very important for us to catch up because there are quite a few alumni in this class that have been taking this class continuously for multiple semesters. And it just kind of became almost like a tradition because what this class does for a lot of our alumni students is it brings the systematic approach to how you develop, how you study the markets and how you develop the skills. So they just keep coming and they keep practicing each week, because each week we have new exercise for them or new exercises, new homeworks. And I think it's a testament to this class and to determination of our alumni to come and to develop as analysts and traders much faster, much better, to understand the material better. So hopefully for those of you who just signed up, who are graduates of WTC1, after you go through this semester, some of you will consider just to stay on this level, or stay in this level and then just take some more advanced knowledge courses like tape reading that we have. And I'm definitely available to all of you guys, our students. If you email me and you ask me any questions about what should you do in your development as a trader, what kind of knowledge you need to go for next, or what kind of skill building exercises, I will most definitely gladly answer those. We're not going to do the anatomy of the trade today, so I apologize for that. So this is going to be our class for today. Market updates, exercise number 1 on observations and deductions, and then we have 3 or 4 bias games that we're going to review. Okay. So here's our first homework. As usual, the first class, we concentrate on reading, just because we need to get into certain ideas and certain ways. We need to create the intention for the whole semester in the way of how we're going to approach our studies, how we're going to approach each class, how we're going to approach each homework. And I suggest 2 studies or 2 reads to my students at this level. One is actually a chapter from the Outliers book by Malcolm Gladwell, and I'm sure that a lot of you have read this, and it's called 10,000 Hours. So this is on the quantitative approach to skill building. So please read that. And then the second piece is the mundanity of excellence. And this is the piece on the qualitative way of practicing. So please note that I'm mentioning both ways. Usually when people hear me talk about 10,000 hours, they start talking about, well, you got to have the quality of your practice. Absolutely. And that's exactly what we have developed here at Wyckoff Analytics. That's exactly how I practice myself. That's exactly what I push on our students. Because I don't want you guys to just do things and do this as a repetition multiple times. This is the craft where you have to be thoughtful and you have to stop when you don't understand something or when you need to repeat something, and you need to think, and you need to think things through. So it takes time. So for those of you who already taken WTC1 course, you know how it is, and you know how we go about things, and you know what I demand from you. So this is just another way for us to create that intention at the beginning of the semester. So please read both of the pieces. This is the only homework that I have for you. Well, actually, there's going to be a bias game as well. So the bias game I'm going to give you tomorrow morning, so on our class page, and you will receive the access tonight to that. You will see both of the articles, and you will see the bias game as the homework as well. We will discuss the anatomy of the trade assignment in the next session. This is a little bit more private for a more intimate setting where we, not going to have any guests. So I will tell you exactly what you're going to do with the anatomy of the trade. We have tested this last semester, and it was just kind of like a mind-blowing exercise. First of all, a lot of students had the feedback to me that this was such a great exercise, and it was very, very useful to understand what kind of traders they are going through that exercise, and just identifying a lot of the things that could be corrected in your trading. So I will talk about this more later on. A question, is this session being recorded, and will it be available for later viewing on social media? Absolutely. The first sessions are like that, open door. So we will post it on our YouTube channel, which is called Wyckoff Trading Method. We will also post a link on Twitter and Facebook. Our Twitter handle is at Wyckoff Analysis, so go check it out. All right, with this, let's go to the market update. All right, guys, and the first question, let's do the pop quiz here. So what do you guys think about the market? I mean, what is the trend? What is the current trend? Joe is saying trading range. Okay. Sideways, sideways, trading range intermediate, Lena is saying. Okay. Long-term uptrend. Trading range mixed. Short-term up. Trading range on an intermediate level and long-term up from France. Depends on the time frame. Yeah, okay. Yeah, I asked the same question yesterday in the WTC1 course. And obviously, I mean, we have students there that are new to the methodology or maybe even new to technical analysis. So, but there was a really good understanding that we were in the uptrend. And your answer, if you're answering this, you know, are we in the uptrend or not? You could say yes, and you could say also no, right? So we want to identify, let's say if we would take NASDAQ currently, right? So you want to identify a very, very long-term uptrend first. So a long-term uptrend is going to be a campaign uptrend, right? So this is something where those huge, big institutions are going to be participate in for quite some time. And then within this long-term campaign, you're going to have, so this is a secular trend. Secular trend. Within this campaign secular trend, you're going to have cyclical lows. And you kind of could see that the secular trend has started with the deeply oversold condition in 2008, 2009, and there were quite a few cyclical lows along the way where the price had some kind of volatility and decline into the oversold, short-term oversold condition. So if this was a long-term oversold condition, this was a short-term oversold conditions, and those were great opportunities, you know, to get in into the market. And after the understanding of how rotation has happened at those spots, you know, come into the positions where the stocks were exhibiting some strength behind the market's weakness, and then just ride the trend until it's done. So if this is the long term, then the intermediate picture for us could be, you know, something more recent. And I think that to me, this type of action where NASDAQ, let's say, had multiple attempts to go up, let's say 4 attempts to go up and 4 of them have failed, 3 attempts to go down, and all of them have failed to continue to the downside. So this is just a trading range. We are consolidating around the mean at this point. So that I would say that the intermediate trend for NASDAQ specifically is sideways or trading range. And then the short-term trend are going to be swings, right? So here are the swings of the trading range that we have here. And it was very interesting because today's bar negated the last commitment to the upside. I think it did, right? So we're kind of closing almost on that same level. But I would say the way how we have tested into the lower high, and we've talked about the lower high yesterday, you know, suggesting that if there's going to be a negation day today, which it was, then we kind of a little bit in trouble because you know, the price might potentially go down and retest the support. We'll talk about this in a second. So currently, I would say that the short-term trend is down for NASDAQ just because of today's reversal that we have had. So now for the upswing to resume, we need to overcome the high of this particular bar. Okay, well, let's talk about this trading range a little bit more in details. So we have talked about how we have had shortening of the thrust into the buy-in climax, and this shortening of the thrust actually is the reflection on the whole uptrend that we have had prior to this. And we said with this shortening of the thrust, despite of the bullish character of the rally, um, we are expecting some kind of stop in action. And that stop in action actually was identified by us on November 5th bar, and we said that most likely we're going to have some kind of trading range. Now, the structure of the trading range has developed in a slightly different way that I was hoping it would. First of all, on Nasdaq specifically, you could see that we are starting with the change of behavior, which is not that pronounced, right? So it's still the best reaction that we have had to the downside since, let's say, this low right here. But it's not as impressive. So with that, we said supply has emerged, change of behavior has happened. Our expectation and confirmation that the trading range is going to develop was here, was that change of behavior. But the way how the change of behavior was not so pronounced suggested that we're still going to have the rally that might actually overcome the stop in action, the buy-in climax, and create some kind of upthrust as a secondary test type of rally. And indeed, it did exactly that, just because of that strength of the change of behavior and suggestion for the trading range. The next rally is upthrusting the resistance level. And then after that, this is where we would be usually having some kind of elements of volatility in early phase B. So if this is phase A, buy-in climax, automatic reaction, secondary test as an upthrust. Now we are increasing volatility, and with that volatility, we're increasing this in size, the sell-in itself. And we're seeing how the downward spread starts to increase. So that's very important for us to note. And as usual, phase B is going to be volatile not only to the downside, but to the upside as well. So look at this bar right here. What a beautiful way of triggering buys with the low volume signature and expanding result within the confines of the trading range. So usually this type of actions, this is where we are going to fail a lot, right? Because it's so attractive. It is so attractive when we see a bar like this. But for us Wyckoffans, we need to understand that we are still in phase B. So in phase B for us is somewhat over waiting game where we are waiting for some kind of possibly final determination of the bias. Now, what we didn't really like about this phase B is their ability of the price to go below the support and creating the lower low. Not only that, that all has happened on a consistency of the presence of the supply and increase of that supply. The next rally was finishing way far away from the actual high of the upthrust action in phase A, which is also showing elements of weakness. And as usual, phase B is going to go into this exhaustion phase. We'll talk a lot about this. And during our semester, this is probably one of my favorite topics right now in phase analysis, phase B characteristics, which are giving us some hints as to what kind of potential bias we could have here. And we're seeing just a slight deterioration of selling. We still have quite a lot of volatility, those big bars to the downside. We're still making a slightly lower low, also not the greatest way to, come into the end of the exhaustion by buyers and sellers in phase B, because it shows weakness. So both of those lows could be interpreted as minus sign of weaknesses. Please note, and this is more for the advanced traders and advanced Wyckoffans, as we had a low, and we would label this secondary test as a minus sign of weakness. I had many discussions with Wyckoff experts that proclaim that after the low, after the minus sign of weakness, you cannot have the rally that's going to make a higher high relative to the previous high. This is not true. Look at this example. After this high, we're making a higher high. This is still a lower high relative to the previous low, but it's definitely a higher high. So it has two definitions here. And the character of this rally is most definitely bullish in terms of how the upward spread is increasing and how momentum is increasing. The problems, so if this is the character, the problems with this rally are twofold. The first problem is that the upward effort is actually very minimal and is decreasing. And it's decreasing on its own, so demand is decreasing and it's decreasing over the previous period where we had a 1 day or 3 day rally as well. So one might say, okay, well, this is the Christmas time, so there is a thin market that we're going through. Absolutely, I have no problem with that. But if there is some kind of next thought would be that there is some kind of ease of movement to the upside, and I think it's usually the intermediate traders or analysts that use Wyckoff method, or they use the VSA, they would be saying, but the price moves easily to the upside. That's so true, but the definition of the ease of movement is always going to be not just the contraction of the volume, but the actual result. What is the actual upward result for NASDAQ in this case? Are we committing above a certain level, a certain resistance cluster? And this resistance cluster could be created in multiple ways. So here is our level number 1, level number 2, level number 3. What do we do here? We kind of go into the cluster. This is the highest commitment that we have on the close. We intraday penetrate the second level. We never touch the third one. So I'm not impressed with this commitment for NASDAQ at all. I mean, like S&P is most definitely better, the Dow is most definitely better, but NASDAQ itself shows that behind what seems to be a bullish character of the move, we have the exhausted effort, and the upward result has also diminished. So that's a very interesting observation, and the deduction that we could make from this is that this is a weak hands rally. And the only reason why this rally is developing, I think, is behind the names like Apple, Facebook. Well, Facebook was not rallying during this time. Google was not rallying. Microsoft was kind of like, almost like semi-rallying. So it's behind those big names that have a lot of weight in the indices. And this is just their way to push the markets and the indices to through the resistance and create such a bullish picture as if, wow, indeed we're in a very, very bullish environment. But in fact, the result of this rally still tells us a completely different picture. It tells us that, well, we rallied to the resistance as we should in the trading range, and that's it. And we are done. So for now, we are still for NASDAQ in the trading range. So here is this trading range with all of the boundaries. Now let's label this. Buying climax, automatic reaction, secondary test as an upthrust, phase A, then phase B. I already labeled these secondary tests as minus sign of weaknesses, and then attempt to upthrust. In this case, you could say that it's either a local upthrust, so local upthrust over what? Over the previous high right here, intermediate high, or this is a failed upthrust relative to the whole global structure. So one way or another, no matter how you would label this, I would understand this, and if we talk, let's say, without any charts, and you tell me the story and you tell me like, okay, the buying climax stopped the movement, then we had not a meaningful change of behavior that suggested the rally overcoming of the resistance, that brought us into the upthrust, that concluded phase A, then increase of volatility in phase B into two minor sign of weaknesses as lower lows, with the potential, with the next rally into potential phase C, and I'll talk about this in a second, which characteristically looked as bullish, but the result of it was still a lower high relative to the upthrust high on a failed upthrust. I will know exactly what you're talking about. So learn to talk like this with your peers and myself, and for yourself as well, right? So describe the labeling through the result and the character of each important Wyckoff event in the structure. Okay, so now let's talk about the latest attempt to upthrust. Again, we're only talking about Nasdaq. Well, first of all, this looks like what, guys? Does it look like this? Is this a point of excitement for us? So if the first point of excitement is our stop in climactic action, then the second point of excitement is going to be what? A pop quiz for WTC1 students, really quick. Write it down. Where is the second point of excitement comes from weekends? Riley is saying phase C, George is saying phase C, Lena is saying upthrust after distribution, just before upthrust after distribution, Brian is saying. Okay, Eden is correct, Jonathan is correct. Into phase C, Michael is saying, yes, absolutely. So if this is our second point of excitement, and it does look like that, right? I mean, look at the nature of the character, the texture of the price and the volume, and it looks like an excitement. So that suggests phase C. Okay, so is there any other confirmatory signs that this could be a potential phase C? Well, looking at the way how we tested that high into the lower high again, which is local, and then immediate reversal after that, also is suggestive that potentially we could have already experienced phase C. And I'll talk about a much more complex structure that we could have with this trading range. And we'll talk about different analogs right here. But this is such an interesting spot where, with all of this weakness, we could not only fail to the support level, and there are two support levels currently, support level number one, support level number two. First of all, I think if we fail here, and it seems like we are failing, just based on today, tomorrow could be a next confirmation if we start traveling on the intraday basis, below this level right here. Not only we will hit support level number one, I think that we could easily hit support level number two, and even go a little bit further down. So we'll have to see how that develops. But so far, supply that came today is somewhat significant. So for the bulls, tomorrow's bar absolutely needs to be, at least at the minimum, an ability to hold at this level. And by no means tomorrow's bar should be a down bar for them, for the bulls, with the commitment to the downside. Because if that happens, that's it. We are done, at least for the time being. At the minimum, we are in the trading range. And at the maximum, we could develop some kind of, shakeout, which could be very fast, which could be, below some of the support levels. So we'll have to see how that's going to develop. But for now, this is the thinking. And then if we're thinking that this could be of the distributional nature, and it doesn't really have to be like, oh my gosh, it's going to be like such a big distribution and so on and so forth. No, seasonally, January and February of second year are going to be a little bit rocky to start the year, and we have quite a few catalysts for this. I mean, we're definitely still working on Omicron. That's number one. Inflation is definitely showing its strength and ability to accelerate. And the Fed, even with the most recent, more hawkish stand, is still probably not enough. And with that, it could kind of bring the institutional money managers to conclusions where they would say, I don't have to invest the cash that I have right away into the market. I could wait for that local volatility event where I will assess better what my selection will be. And, I will put the money to work at that point of time. Having said this, there are definitely some areas that are extremely attractive even today, like energy today was really great. Energy yesterday was really good. And, I've actually been adding, to those positions. I have not been adding, let's say to technology. There was no reason to do that. And by the way, for those of you who are interested in the selection analysis, in the rotational analysis, tomorrow Bruce and I will be giving our market outlook for 2022 in WMD class at 3 p.m. So sign up for that. It's going to be a lot of fun. We were discussing it with Bruce today, and I just really like all of the slides and the material that we have already. Okay, so imagine if this whole thing is the distribution, then our whole causality will be this, right? So this is our last point of supply, and this is our buying climax. So if the price will go down, we most definitely will start measuring this whole thing. So here's segment one, segment two. We don't have to have a significant, distribution. We could have some kind of shakeout type of action that breaks the overall stride of the trend and maybe retest previous support. So something like this, and then we go and we consolidate again, and then we could recover from here. So this could be one of the softer landing type of scenarios, especially for NASDAQ. And the reason why NASDAQ, in my opinion, is just so kind of under pressure with current selling is because of the interest rate. Because technology stocks are very sensitive to the interest. They need to borrow a lot. So when the money becomes more expensive, it's most definitely much more difficult to grow at the lower costs. And incidentally, I mean, look what a 10-year yield has done just in the last 2 days. It's not a coincidence that today's NASDAQ action is showing so much weakness, just because the interest rate, the yields are actually showing some strength. So those are most definitely, correlated in this way. And we've been talking in many classes about the yields and the interest rate, and since basically August, November, around this area right here, we've been talking about higher interest rates, and that the Fed is going to be trying to catch up with the interest rates, that we're going to have inflation, and that inflation is going to be very unique because the acceleration of the interest rate is just so unique on its own, that economic data, when it's going to come it's going to impress us, and it is. Now that we are receiving economic data, for the last 6 months or so, it makes sense what we saw on the tape. It made sense to the conclusions that we made, either in early 2021 or throughout, and it was making sense also through the rotation away from technology stocks into value stocks, and then when technology stocks were oversold, kind of like mini rotations. And the whole 2022 was very, very unique because I do my institutional hedge fund work as well, for those of you who don't know. And I was just talking to my partner at hedge fund, and we were discussing how difficult it is, or was in 2021, money management from the perspective of the outperformance of the S&P 500, which made 27%, because you basically, if you're not 100% invested in S&P 500, it's going to be extremely hard for you to be diversified in such a way that protects the capital of your clients in a meaningful way, and yet through all of the positions that you might have, let's say you might have between, let's say, 15 to 30 positions, through all of those positions to outperform S&P. And that's why I believe, close to 90% of money management underperformed in 2021. And to me, that's just an unfair game, just because you are not allowed to put all of the money in the S&P. You're not allowed to put all of the money in 5 stocks, which would be, like Netflix, Apple, Google, Nvidia, and so on and so forth. You have to control the risk. So this was a really, really bad year for the money managers, as 1995, as 2017, and most recently 2021. So very interesting, and we'll talk more about this in tomorrow's WMD. Okay, so what else could we say about the markets? Let's talk about the S&P. Well, here we would still say that the short-term trend is up. We have not reversed the most significant bar to the upside yet. And here is the level that we're expecting. And there are actually 2 levels here. So level 1 and level 2. Level 1 is more of the local test that we have here. And I wouldn't be surprised if we, after some volatility, let's say where NASDAQ is much more vulnerable locally at this spot, there's some kind of stabilization. Let's say tomorrow, it might go down, but not as much, or it might might stabilize and kind of stay in that down bar that we had today. And with that, S&P, just because it's stronger than NASDAQ, might have an opportunity to go up from here. We're still in the upswing, so the short-term trend here is still up, and you should definitely trade that. But keep in mind, if there's going to be a commitment below level number 1, that's your first confirmation of the deterioration. If you're going to have the commitment below level number 2, that's going to be most definitely the confirmation that now from the upswing we have reversed into the downswing. And that's kind of like these 2 scenarios that we look at: a test that is a successful test for bulls and a continuation, or commitment below the last significant bar, and then the price comes back to the support level. The Russell is still in the trading range that we've talked about for quite some time. We said that Russell was very unique in the way of how many changes of behavior has happened here. So for instance, the first change of behavior in the trading range suggested that we're going to go into the consolidation environment. The second change of behavior was suggestive that we might be attempting to create a change of character. And change of character, as you guys know from WTC1 course, is different from change of behavior. A change of character is more of a structural thing, where we would be expecting the rally to be sustainable, meaning that the followed reaction is going to hold and then going to show continuation. but it wasn't because the price came back to the support, and that change of behavior has failed. Then the next change of behavior, and again the same thing, failure. So in both cases, we had those failures, and the whole trading range now exhibits 4 changes of behavior and only 1 change of character, which has happened at the beginning of the trading range. So we are specifically studying right now the most recent change of behavior that has suggested that the context and the background is to the downside. So with this background, the most important bar is this. And what do we see in the context of that bar? We're seeing attempts to overcome 1/2 of that bar, and obviously the high of that bar is extremely important. And we are failing. We failed once, twice, and then this is kind of like a grouping cluster of bars currently, which still under question. We still need to see, could we potentially do that? Now, attempt to do that on the expanding volume signature has suggested some presence of the supply. But today there was a bar where supply was present, but still the price was holding. So some attempt to observe. I think tomorrow's day is going to be extremely important. Would we finally break through, or would we negate the last attempt to go up? So one way or another, there is a significance in the next price action, in the next result. So we'll definitely need to figure it out tomorrow, what's going to be the directionality of the next move. Obviously, NASDAQ is showing already some weakness, so defines the move more to the downside than to the upside. And then other indices might just confirm that. The strongest of them all is the Dow, obviously the new high. Don't forget about the composition of the Dow. So big caps. And when there is some kind of trouble on the horizon, what do money managers do? And I remember we were doing this in a hedge fund in November and into December. Basically, the money go to big mega cap stocks because there is a flight to quality in that type of move. Not only those are providing kind of like the big platform, big type of businesses with a lot of revenue. There is also a lot of liquidity, and if there is some kind of capitulation by the market or by the specific sector, like growth tech stocks, ARC stocks, those are going to be very difficult to get out for money managers. The big stocks, the big mega cap stocks, those are much easier to get out, even if you're capitulating. So the Dow is just a the strength in the Dow is just a reflection of that. Okay, what else? Let's talk quickly about gold. So Enigma still stays enigmatic, but we definitely could make some observations that are going to be valuable to us. So a big change of behavior, rally, and then look at all of the subsequent reactions. Number 1, number 2, number 3, number 4, and now number 5 developing, right? So what do we see through these 5 reactions after a change of behavior? Well, first of all, we have not broken the support. We have not committed below. And that attempt to commit below was brought to us on smaller selling pressure, so which is good. After that, we have higher lows, which is also really good. We also have a higher high here, which is also really good. And we are most clearly in some kind of testing right now of this shakeout type of action. So that seems to be creating maybe like a background for a switch into a more positive, bullish type of environment. Now, for that to happen, for the bulls to overtake the bears in case of gold and silver, therefore, we really need this reaction number 5 to stay where it is and not produce a meaningful decline. Maybe just to go a little bit lower and then still consolidate, produce even smaller reaction, decrease the volatility, and then explode to the upside. And I think that it's possible, especially if we are going to have some kind of trouble with the market. So, we'll kind of have to see what's going to happen here. But the extent of this last reaction is going to be extremely important. I like the way how the supply has diminished, and I like if we stay here. I like that there was no follow through to the downside today. So that's somewhat of a bullish type of development. Okay, let's go to oil, and then we'll finish with Bitcoin. So in yesterday's and today's news, OPEC is not willing to increase the production, so therefore the prices of oil are going up. We said that after, again, a meaningful change of behavior, and it's so interesting how all of the markets exhibit this type of shakeout change of behavior just recently. And almost all of them have some kind of important bar in that shakeout action, in that change of behavior. So that bar usually defines the range for us, or at least the first initial boundaries of the range, and then you have the outer boundaries. So here's our trading range. If this is a stop in action, automatic rally, secondary test, I think that the price is gonna just go up and down. Again, I call this the oil war between OPEC and current U.S. Administration that doesn't want the gasoline prices to be very high. So there is like the political pressure, but I think that behind that political pressure, I think this is more of an excuse. We've been in the situations when we had oil at 148, and as much as they talked about the political pressure, I think they are more concerned about the inflation, because the inflationary numbers, if you look at the weight of oil on those inflationary numbers, it's almost the largest, the biggest impact that oil has on those inflationary numbers. So they most definitely want the oil to stay at least at this level or even to go lower. And OPEC obviously is opposing that, because for a lot of OPEC countries, to be above $60 in oil price means that they are extremely profitable. And to stay above that level and to be, let's say, at 80, 90 and above 100, that's kind of like super profits for them. So nobody wants to lose that. Nobody in the world kind of like listens to the US in this regard. And that's what's happening. So short term, I think we're going to see volatility where the price is going to go up. Then maybe U.S. government is going to release more supply from the reserve, and then that would propel the price back down. So in other words, a trading range. And the tactics here that I think are the best is just intraday and swing, short-term swing trading. Picking up moves like this, where you have 2, 3, 4 days of high momentum, either to the upside or to the downside, and you're benefiting from that. Having said this, obviously you could go to energy sector, and I mentioned already that yesterday and today was a really, really great example of energy outperforming the market. Okay, Bitcoin. I was discussing it with William in the Monday State Trading course. By the way, guys, for those of you who are new to our community, check those out. Those are a lot of fun on Mondays at 9 a.m. Pacific. We conduct those sessions. We discuss the market. We also do some exercises, and the ability to read the chart in the correct way is a very rare skill, and I'm very fortunate, to have William helping me out in that regard each Monday, trying to decipher the market, trying to see where we are. We always have a lot of fun doing this together. And as we were discussing this Monday, the Bitcoin, the question become, when we look at this bar, and the way of how demand tail has unfolded, what does it tell you in terms of the potential bias, or even like the strength or the weakness of the whole formation that is about to come? So my answer to William was not necessarily just the ability of the demand to to construct a specific shape of the capitulation bar, but what comes after. So the automatic rally, the extent of the reaction of the low of the capitulation into the body of the capitulation bar. So we had instances, a couple of instances where we did this. So we're seeing that in this instance, this was a pretty weak recovery, suggesting more weakness ahead. And then we had this low from the selling climax into where, look where automatic rally has come to, almost to the high of that bar. So this ability of the automatic rally to recover all of the losses on the capitulation bar would be suggestive of the upward bias. Whereas, let's say, here we are still thinking weakness, and in this case as well, we're thinking that the structure of the trading range is going to be weak. So as Wyckoff always would say, judge the market by its own action, and that's exactly what we're doing here. I was not impressed with any of the rallies that we've seen, even with this one. This rally just comes to the level of the resistance that was defined by the automatic rally, and then fails on the expansion of the result to the downside, and also on the expansion of the supply. And the subsequent attempts to rally not only have diminished demand character, but also no result to the upside. Still weak. And if we break this level, most likely we're going to go and revisit 43, and I would say even cluster here, 43 and 41. And we could have some kind of sprint type attempt, and I would say this is a type, this is not a sprint. As David Weiss would say, you could make the living trading upthrusts and sprints in different trending environments. So the trading a sprint in a downtrend, which was already defined by the change of behavior that we have had right here, is very difficult. Out of 10 times, nine sprints are going to fail in the downtrend, and only the last one, like this attempt to sprint, is going to be successful. So we would have to see what's going to happen, but for now, my conclusion on this day right here at 56.55 was that I need to get out of my initial positions. So these were my points of entry on Bitcoin: point of entry number 1, point of entry number 2. Not perfectly timed here, but still for the kind of like a long-term picture was okay. And I thought that here was such a point of vulnerability where you have to exit, or at least meaningfully scale out, which I did. And I think that so far, I'm not regretting this decision, and we'll have to see what's going to happen next. But for sure, this local trading range is somewhat weak. Okay. All right. So let's see where we are. Ooh, wow. 4 p.m. It took us a while, but I was on a roll. I liked it. So I'm glad that we went through quite a few of them. All right, with that, let's just jump back to the class, and let's just jump back to our material. Let's talk about the main issues that our students have with their analysis. There are two main issues that I see as a teacher, and I've been teaching this material for over 10 years now, straight. So I've conducted more than 35 cycles for this material. And that, not consider, and each cycle has, 15 sessions, plus some, specials, plus private sessions, plus presentations, and so on and so forth. So I've been around. I've been around people. I've been around students. I've been around traders that come to me, that bring their charts, and they talk about their analysis. So what have I learned from them or from their analysis, as to what kind of mistakes they make or what kind of mistakes we usually make? There are two very important things that we disregard or we don't know or we miss. Usually, our observational skills are somewhat poor. Let me give you an example. You all are sitting somewhere right now, probably some room in some kind of building. Maybe somebody is listening to this recording from the car, maybe on the phone, but you're still somewhere. So, and this is probably somewhat a familiar place for you. You've been there before. So you have seen that place, you've been there. If I would ask you to describe to me in all of the details the place that surrounds you, meaning that I want to know how many trees, what kind of trees, how many branches, how many leaves those trees have, what kind of weather you have had today, what kind of houses are around you, how many people have you seen, as you were coming to this place, what were they wearing, what kind of cars were around, the building that you're in, the features, the details. Would you be able to answer all of those questions correctly? Would you be able to come to me with all of the observations from your memory? And even as you, let's say, stand on the street and you're trying to describe what you've seen, could you come up with all of the points of data that you've seen? And 99.99999%, I'm going to say that no. And the reason why is there are two reasons. Is there are just too many data points that you have to observe, and our mind just cannot observe so many data points at the same time. And secondly, we're just not necessarily great visual observationalists. It just kind of our nature. We can't comprehend in real time a lot of information that comes to us, a lot of data points. So now think about the chart, right? The chart is going to have how many bars that you look at? Let's say like a yearly daily chart is going to have 222 bars. Those are the trading days. And not only that bar is going to be the price bar, but also you're going to have the volume bar. You're also going to have references to time. So you have 3 dimensions there times 222 days, trading days. Plus each bar is going to have your open, close, low, and high. Also, it's going to have some kind of coloration in terms of the bias, whether you're looking at the red bar or you're looking at the green bar. That's what I do on my charts. So green is up, red is down. So you already have 222 trading days. You have 3-dimensional chart where you have the price, volume, and time, and you have 5 points on the price, 5 data points on the price, and then you have also the data points on the volume bars. When you compare them to each other, you also will be comparing the price bars to each other, and not only bar by bar, but swing by swing. You will have different definitions of the buys at different structural spots. So there is so much information on the chart that you have to see in order for you to make correct observations. So we generally just lack observation skills. The second problem is that when we observe, we kind of observe in a non-objective way. And what do I mean by that? If you have a chart that is kind of like a boring chart. We have a trading range, and then you have some kind of meaningful shakeout, and then it becomes boring again. What is the most interesting part of this chart? Where would your eye go to? What would be your first initial observation? I bet you that a lot of you are going to be concentrating their attention right on the shakeout. And that's just a very, non-objective way of observing the data on the chart. And then the last thing is that there are no sufficient number of observation data points that we make. And I kind of alluded to this a lot, so I'm not going to go into this. So just in general, our observational skills are very poor. And one of the things when I realized teaching this material, one of the things that I kind of stumbled upon is that with such poor observational skills that we all have and our students have, we need to lift it up. We need to make sure that when we practice those observational skills. And the key there is obviously to understand what is it that we are looking for? What is this that we are observing? There are specific things that we need to obviously concentrate on, and those specific things have to be important things enough for us to observe, to understand that even though we can't observe everything, those are going to be important enough things for us to produce the correct deductions. Now, after the observation, we go into deduction mode, right? So we're deducing from our observations as to what do we actually observe, and what does it actually mean for the next short-term or long-term market structure? How does the structure should unfold? And again, what I realized is that even our deduction skills are not necessarily that correct. So sometimes we deduce incorrectly. We come to the wrongful deductions, and it's very important from WTC1 to WTC2 class for you guys to develop that critical logic, which is the correct logic for you as to what's going to come next. And we know that Wyckoff methodology contextualizes a lot of things for us. So we know, for instance, from phase A, after phase A, we should start experiencing phase B. We know the characteristics of phase B. We know that the first one half is going to be much more volatile. The second half is going to be more about the exhaustion. So if we are able to observe this, we could deduce that we are switching, let's say, from phase A to phase B, from the first one half of phase B to the second half of phase B. Then there is an anticipation of some kind of rally. We need to assess the character of this rally and so on and so forth. So I think that Wyckoff method is very unique that way. It kind of reminds me a little bit of the Elliott, where the market structure unfolds also in a specific sequence. So you're almost like given, that sequence. So, initial deductions based on our observations need to be correct in order for us to be on the right side of the market and the trade. What I'm also noticing throughout all of this here is that sometimes for students it's really hard to systematize both observations and deductions. So we've been working very hard on that, especially in this class. And I'm, as from that systematic exercise that I've given you guys in WTC1 in the second month, where we go through the price volume analysis, swing analysis, Wyckoff labeling, and bias exercises, and so on and so forth. I have given you a specific way of how I want you to think about your observations and your deductions. We're going to extend on that. So with the bias game, what we're going to do is we're going to have two approaches. And we're going to talk about this in the next class, where I'm going to give you a flashcard idea, which is based basically on, the main observations and the main deductions that we could conclude from the chart and come up with the bias in a very effective way. And the second way, which is more systematized, where we are looking at different things starting from the background and then going into different things. I'm not going to say those in this free recording. So for those of you who's going to sign up for the class, we're going to go into the depths of that type of analysis as to how do we actually analyze? I mean, like, what are we looking at first? What are we looking at second? What are we looking at third? And what kind of deductions are we going to make from those observations? So we kind of created that algorithm in the way of how we are going to observe and deduce, especially the bias. And then, obviously, given the weight of evidence to specific events, this is where your attention to the specific observations are going to be extremely important. So that shakeout and the recovery out of that, and the, let's say, the character or the texture of the volume signature behind it is going to be extremely important for us to observe. So obviously, we're going to give more weight to those type of observations and deductions, and we'll talk about this as well. Okay, well, let's jump to the exercise. So this is probably one of my favorite initial exercises, for this class. Here are your 4 price bars and 4 volume bars. So this is your data. I want you for now to think only about one thing. I want you to make as many observations as possible about this data point. I'm going to give you probably half a minute to a minute just to think about this, to look at this chart, to think about this, and then I'm going to come back. I'm going to go grab a drink. And when I'm going to be back, let's talk about what you're seeing. So you will be writing down what you're seeing, guys. All right, so get ready, and I'll talk to you in 30 to 60 seconds. All right. So let's see where we are. Okay. Go ahead and write down what is it that you see. Okay, so bar number 1, long supply tail with high volume. Okay, so let's talk about bar number 1. Why don't we do that? Let's be a little bit sequential and specific. Okay, so long supply tail. So agreed, supply tail. So supply tail we're seeing here. Okay, so what else about bar number 1? I apologize, guys. Let's just do bar number 1 first. Has the highest high. Okay, so highest high. Okay, so what else? Has the largest spread. Okay. Okay, so what else? Has lowest close. Okay, has the highest open. Okay. Okay, great. What else? Okay, just looking through a lot of what you wrote. Lots of result to the downside. So the downward result is increasing. Okay. Okay, supply, dominant supply is increasing, demand is decreasing. Close at the low. Okay, yes. So we said this, close to spread, close at the bar of the at the bottom of the bar, closes near at the bottom of the range, has small demand tail. Okay, small demand tail. First bar shows a lot of supply. Okay, body is halfway up the total spread, second highest volume out of the 4. So, okay, great, second highest volume. Okay, great. So you kind of could see where we're going with this, right? We probably could have done other observations about bar number 1, right? So Lena is saying looks climactic. Okay, let's put this climactic. Okay, so for instance, open here, this is close. Open somewhere in 1/2 for the bar itself, right? So open at 1/2 of the spread. So, and we know that because of that tail, the intraday structure of this bar is going to be open. Most likely, we have gone up first and then just selling, 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 and then we're closing like this. So open, high, low, and then close. So that's bar number 1. What else here? Yes, and relatively high volume signature, right? So out of all of the 4 bars, this is one of the highest volume signatures. So, and I like this kind of like, first of all, we're describing a lot of data points right here. So that's really good, guys. I'm really, kind of impressed here. Secondly, we could probably already make some kind of deductions about this particular bar. So one of them is, which was given to us by Lena, is an idea that with that type of high volume signature, with that type of intraday into the high and then into the low movement where supply is dominating demand and increasing, we're probably talking about some kind of climactic action. Okay, could we confirm that bar number 1 is climactic in nature by looking and observing the next 3 bars? So let's do exactly that. Bar number 2. Let's talk about bar number 2. What do you guys see there? Let's make observations first. Do not jump to the conclusion right away. Observe, make observation. Automatic stop in action. So there is no follow through to the downside. No downward follow through. Okay. What else? Inside body of bar number 1. Inside bar. Great. Okay. Decreased spread. So spread is decreasing. Okay. Decreased volume. Okay, volume is slightly decreasing. Okay. Bar number 2 opens higher and closes higher than close of bar number 1. So I'm just going to say, Franz, that this is an up bar. How about that, right? Okay. Intention is to close above the open of the prior day, which fails. Okay. This is a very interesting observation, George. So I'm going to kind of make an asterisk here a little bit. So intention was to overcome open of bar number 1, okay, and then that led to failure, which basically, if we would deduce, if the failure has happened and we're seeing that there is both, supply tail is somewhat bigger than the demand tail. So we see that the failure could be local, could lead to the local test. So this is a deduction based on this intention. So this is kind of like in this category right here. Okay, what else? Demand is dominant. Okay. Volatility decreased. Okay. Close above 1/2 of the spread. Close in the top 25%. Okay, guys, maybe I missed something, but yeah, I like all of these observations. So we have bar number one, which is, we deduced that that bar is climactic in nature. So if this is a climax, then, and if this is a stopping action, should we have a follow through to the downside? No. What should we have? We should have some kind of demand coming in on bar number one, stopping the downward movement, and that should start propelling the price to the upside. We also should have some kind of increase of the demand on bar number two. I would say that, the volume signature for me on bar number two is almost equal or slightly less or equal the volume signature of bar number one. What kind of deduction would we make here? Because of this statement, what kind of deduction do you think that we could make here? So I'm going to translate this a little bit because I'm not seeing the correct answers so far. A lot of you are saying like that the demand is there. Okay, yes, demand is there. But what about the supply? Is there supply in bar number two? Okay, and you're saying diminishing supply. Okay, but if there is a supply that is available, because what we're basically saying is looking just at the spread, right? So if effort on bar number two is somewhat close, the same as bar number one, and at the same time the spread of bar number two has diminished and less than the spread of bar number one, that tells us that, supply is still there, supply is present, and demand is expanding. But because supply is present, we could potentially have some kind of test, and that's the deduction that we could make from this statement. So it's very interesting. Bar number one, we're saying that our deduction based on observations is that it could be a climactic bar. Bar number two, the deduction here is that, well, we are most definitely having the emergence of the demand, and we have no follow through to the downside. So this is a change of behavior that is happening on bar number two. And what about bar number three? Let's make observations and deductions about bar number three. Okay, what do we see, guys? Demand tail. Yeah, so and this is the largest, I'm going to say the largest demand tail that we have. So therefore, right away, the deduction here is what? The demand is present and is expanding. And that is being confirmed by what? Confirmed by what observation? What about the volume signature? The volume signature is the highest, right? So we definitely know that demand is present there. Okay, so next. Okay. Test of bar number one. Okay. Of bar number one. Yes, absolutely. So how are we testing it, by the way? What's the nature of the test? We are making a low, and then we recover immediately. What kind of deduction would we make from this statement, from this observation? Right? So yeah, potential spring. And we could say this is kind of like already the final product, but I like here, who is this? Jay, I think, is saying, so this is an element of strength. And obviously, with the increase of the demand, that kind of confirms that the strength is there. Okay, great. Let me come back. Largest volume, demand tail, weaker push to the downside, increased volume, less downward result, open to close than bar number one. Yes. So look at the construct of the body of bar number one and bar number three. We're seeing that the open to the close now is less for bar number three. So open to close is less than bar number one. Okay, which tells us what? Which tells us that the commitment that we usually look at the close in the directionality of the buys is not there, or is diminishing relative to bar number one. So the deduction here that we would say is that the sell-in is less aggressive, and buying is taking over. And the next day would define, bar number four, would define whether this statement right here is true or not. So right away, let's just jump to bar number four and kind of make that conclusion. With bar number four, after the test at bar number three, with being bar number four being an update, with the having the highest close, so up spread, highest close, and follow through to intraday rally on bar number three. This is all indicating what, and what kind of deductions could we make from this? Bar number four commits above other closes, highest close. Bar number four confirms the test of bar number three, highest high on decreased volume, downward effort, increased low result, and so on and so forth. Okay, bullish, supply and demand both lower, exhaustion of both sellers and buyers. Demand is increasing. Yeah, and the result is increasing. So look at the volume signature. This is such a great observation here. So volume drastically goes down on bar number four, and yet we have the highest close, not just up close, but the highest close just on any of those bars. So on the decreased upward effort, we have a better upward result. That's our ease of movement definition, where we are committing specific above, specific levels. So from this sequence of observations and deductions about specific bars, or the sequence of these bars, what do you think the next move would be? Continuation to the upside, up, higher, up, bullish, up. Everybody's on the same page. And yes, indeed, from here, we continue to go up. Does it make sense to do it this way? To make, the correct observations about each bar with all of the data points that we need? To then deduce what each bar means on its own, and then in the context of the whole, price structure that we have. And obviously, we could do this with swings as well. And then connecting all of the bars together and deducing what's going to be the most probable next step. and all of you were correct. And I think that, just working with WTC2 students and just seeing their work on the weekly basis, for years and years, I think the most important statement that I could say about the chart reading is that you really have to go into the details and make those observations correctly. And then I think deductions will come much, much easier if you are observing objectively and if you're observing enough data points and if your observations are correct. I mean, sometimes I see somewhere the discrepancy between, let's say, what you guys are deducing and what in fact are happening. And sometimes, we have to align this a little bit better with the knowledge that we've received in WTC1 course. But usually deductions are much, much easier when you start observing the chart correctly. It just kind of comes naturally. And, you through this simple exercise with this, 4 price bars and 4 volume bars, you could see how easily we come up with the bias definition of what's going to happen next. Well, of course, the problem, with us looking at the chart is not that, we could, easily decipher every chart like this. What if we have many data points? How many data points do we have here? Tons, right? So many bars, price bars, so many volume bars, so many definitions of bias for each bar, so many highs and lows, closes and opens, different volume signature. And I'm just going to give you kind of like a hint here that this is the S&P futures. So you have pre-US session and then the US session. We have some seasonality of the volume signature as well. We have now swings that we could look at up and down. We have different structures. Those are consolidations, uptrends, downtrends. Within the trends, we have counter moves. In the trading ranges, we have resistance support, movement between those. So as the complexity of the structure increases, so does increase the number of data points and also the ways of how we collect that data by comparison. So when we have more data points, we start comparing those data points to each other. So for instance, we could compare how do the, let's say, expansion of the downward bars is happening. What happens to those on this chart? And by comparing those, we could make some kind of deduction. So with this in mind, let's make as many observations as we could about this particular chart. So just start writing those and I'll go through those and we'll do this together. What do you guys observe on this chart? Second point of excitement to the first point of fear from Eden. Okay, where is that? Where is that? Where is that, Eden? You have to be a little bit more specific. A downtrend. Yes, so we have lower highs and we have lower lows. This is a higher low here. So yeah, but the background is most definitely a downtrend. Lower highs, lower lows. Okay, last low is a higher low so far. Okay, rally is getting larger. Okay, so how do we observe that, Michael? So we have, let's say, rally number 1, 2, 3, 4. So I see 4 major rallies. So I would say that the largest rally that we have is number 3. So 3 is the largest rally. Okay. Okay, so what else? Major sign of weakness. So we have some kind of weakness here. Okay, let's call it a sign of weakness. I would be probably be thinking here as sprain. Just a way of how the price recovered back into above the support. From distributional structure into the selling climax. So somewhere a stop in action here, climactic action. Okay, shortening of the downward swing. Okay, shortening of the thrust to the downside. Down results are diminishing. Downward results are diminishing. Shortening of the downside, less aggressive moves taking longer to the downside. Okay, so we could say that the duration of reactions has increased. Okay, selling is less. So what could we say? Maybe like the supply is less, right? So let's just say that supply is less. Change of character possible trading range. So I'm probably be thinking that we are in the trading range environment here. So there are two environments here: trading range, downtrend, and then trading range again. Last downward bar has higher volume than prior bars. Do not commit below the low, stays above 1/2. Okay, so we're talking about this. Okay, down spread diminishing. So down spread is diminishing. Volume increasing at lows of last major downswings. Okay, so here, so volume spike, volume increase. Okay, no increase in volume. Okay. Initial large volume assertion trumped by lesser volume with significantly more down. Okay, huge sign of weakness. Let's go this to wait for a change of behavior. Okay, last rally fails to overcome significant bars. Okay, so failure here. Okay, test of the spring. Capitulation may occur at chart's low. Okay, so we have this as a selling climax. More supply weeks than the demand weeks. Okay. Yeah, depending on where we see this. Okay, so I think that this is sufficient. I mean, like this should be sufficient information, sufficient observation points for us to make some kind of deduction. So let's repeat all of this. So we start with the trading range, which has its own minor sign of weakness, then a major sign of weakness, last point of supply, so distributional nature, and then we go into the downtrend, which concludes with the stop in action, and then we go into the trading range. So the trading range is of interesting character. First of all, we have a lot of strength. So phase A starts secondary test at the higher level above 1/2. So this is usually bullish. Just as the prelude to the whole structural bias. Then we have an upthrust, which is committing to the upside in a very, very significant way. So there are a lot of progressive closes to the upside that we see specifically for, and we are definitely seeing this as more of a bullish behavior rather than bearish behavior. Then the next reaction to the downside, we would be thinking about the comparisons of the reactions. So let me just take another color. Reaction number 1, reaction number 2, and then reaction number 3. So what do we see with each of those reactions? We have not made those observations, but what about the volatility from, let's say, reaction number 1 to number 3? Most definitely it's diminishing. Okay, so what's happening, and we've had the downward spread here. It's kind of the same. So every time we have the reaction, we are looking at the downward spread. What is the downward spread is doing? diminishing as well, right? So if volatility diminishes, we definitely would see the same in the downward spread. What's happening with the supply from one reaction to reaction number 3? Most definitely diminishing as well. Okay, so what is the result to the downside of those reactions from 1 to 3? What we have, shortening of the thrust on the reaction number 2, which is bullish, inability of selling to produce a more meaningful commitment to the downside. And then reaction number 3 is the higher low. So this is even more bullish. So that's what we have. So with all of these observations, what are we seeing here? Even though the background is still to the downside, do we see any characteristics that are changing or showing us that the selling is diminishing? Are we seeing any of the attempts? Well, let's just talk about selling. What do you guys see from the reaction number 1 to 2 to 3? Is selling diminishing or increasing? Most definitely decreasing, right? Or diminishing. So our deduction here is going to be is that selling is decreasing. If selling is decreasing, the next deduction that we could make is what? What would we be expecting next to happen? A rally, correct. What is the next task for us when we identify that the rally is going to happen? Okay, a lot of you are saying buy. I'm not talking about the tactics or the trade management. I'm talking about the analysis. Michael is correct here. Define the character of that reaction. Okay. Before we do that, let's just keep this in mind. Let's just keep that in mind that the selling is indeed, is deteriorating, and our expectation is we're going to have the rally, and then we're going to define what kind of character of the rally we're going to have. What about buying? How would we describe buying on this chart? Weak, exhausting both supply and demand. Okay, well, let me ask you this question. Where do we see the buying? Jason is saying it may have reemerged at the bottom. Okay, so most definitely we see buying on the way down. And again, this is the material of WTC1 course. When we have a downtrend, we will most definitely have some buying at the conclusion of the climactic run into the selling climax. And this would be the buying on the way down. As the price still goes down, big interests are coming in and starting to buy. The second type of buying we're going to have on the way up on the automatic rally. And we see that demand is present there, and that produces the initial result. Testing, and then some buying after the breakout. Okay, great. Then the same thing with the second reaction, buying on the way down, then buying on the way up, and then the consistency of the demand signature here, consistent demand, suggests that there is buying on the way up, and this rally is most definitely better than the rallies in the last downswing. So is there buying present? Yes. It's not as great as the selling per se, right? Because we're still making those lower highs. There is no a very definitive change of behavior or change of character, but there is some buying. So this is a very interesting picture. We're saying that buying is present, but needs to produce a meaningful change of behavior and change of character. Meanwhile, selling is getting exhausted. So here is our analysis at this point. Based on this analysis, our tactics would be to buy on some kind of reversal. Okay, so if, let's say, this buy is being reversed like this would be our point of entry. Our expectation will be that we're going to produce the rally, which is going to equate to the change of behavior. Then what would happen next? What were we looking for after the rally? Backup action, sign of strength, test. James is correct. Then some kind of testing action, which is going to be reactionary. So we need to assess what kind of character of the reaction we're going to have. Okay, so we're basically looking at the rally, and then we're looking at some kind of testing action. And we need to assess the character of this. And then we're entering the position, even though we don't know exactly what kind of character we're going to have. We don't know whether this test is going to fail or not. And that's trading. That's living and going through the uncertainty of the market, which sometimes students really forget what trading is all about. I mean, like, seriously, guys, do you really know what's going to happen tomorrow? No. Somebody might come in and just start selling or buying for whatever reasons they have. And that's what's going to produce, that uncertainty. But if you're going to have a lot of data points, like we're looking at the whole day, then you could see some edge in, identification of the environments that we have, whether there are consolidations or, some kind of trending environments. So don't forget about this. Okay, so let's go to the next continuation chart, and this is what happens. We said that we are expecting some kind of rally that could start with the reversal. So here is our reversal, which equates to our first initial point of entry. And you might have multiple points of entry. This is something that we'll discuss in further classes and so on and so forth. So a sign of strength, yeah, perhaps minor sign of strength, not major sign of strength, and some kind of testing. Doesn't necessarily have to be labeled as the backup action. We could label this as the minor backup action, or we could label this as the last point of support trading range. Okay, so what are your observations now on the rally? Is this a good rally or is it a bad rally? Is this a bullish rally or is it not? And the way to come about this type of deductions is to look at the spread, to look at the distance, to look at the result, to look at the effort, which is basically the difference in the volume signature. So what are we observing here? Best rally so far. I would most definitely agree with that. The distance of the rally, maybe not as much as we've had before, but the way how it unfolds and the effort behind it most definitely gives us an objective observation that this is, and deduction that this is the best rally so far that we have had. Highest volume on the stopping bar. Okay, yes, so presence of supply, suggesting what, Lena? That this supply needs to be absorbed. How do we absorb the supply? Through consolidation, through time absorption, right? Test is upslope in trading range. Really good observation. Usually upsloping ranges, and this is a continuation of the what is the background right now for us. The immediate background is up. So upsloping structures are reaccumulations to be confirmed or fail, or to fail. And most definitely, the rally is just saying like we are bullish. So deduction about the rally is that we produced a change of behavior, which is now bullish. Okay, how about the test? We set upsloping, so reaccumulation to be confirmed or to fail. What else? In this trading range, what do you guys see? How's the change of behavior for the trading range? Did we retrace the whole rally? Or did we retrace what? 1/3? Half? Probably around 1/2, 1/3, right? So 1/3 to 1/2. So bullish retracement. We don't see a lot of supply on that retracement, which is also bullish. Then the majority of phase B, where do we spend? Are we spending it closer to the resistance or to the support? And if we're spending it in the upper half of the trading range, what does it tell you about the institutional behaviors in this moment? Do they give up their positions or do they hold on to their positions? Definitely holding on to those positions. Okay, next reaction, which is on par of the same magnitude as the change of behavior. Second point of fear, suggesting what Wyckoff event? Phase C, and an attempt to spring, and we can call this either a local spring or last point of support, depending on how you're going to label this. Relative to the test in phase B, that's a local spring. Relative to the whole global structure, this is a last point of support because of the higher low. Okay, so with all of those observations that we've made about the testing, is the test bullish or bearish? Definitely bullish. So what do we expect if we have had a change of behavior and now a bullish test suggesting that we've just experienced a change of character? A change of character that happens twice in the trading range, right? So a change of character initially on the selling climax automatic rally secondary test, suggesting that from the downtrend, now we're going into a trading range environment. And the second change of character where we are having a change of behavior as a sign of strength, in this case, a minor sign of strength, followed by the reaction, which is the minor backup action or a last point of support trading range. So here's our second change of behavior. Are we done with the trading range? And what is the continuation out of this? I mean, everything looks bullish. Rally is bullish. So look at, and this is, again, this is where I'm losing you guys a little bit, right? Look at how we are going from phase number 1, distributional formation, phase number 2, downtrend, phase number 3, consolidation, where selling is being exhausted, right? So up to, let's say, this point right here. Phase number 4, a change of character. I'm going to write it down. Distribution, downtrend, number 3, trading range, where selling is exhausted, and then buying is emerging. And phase number 4, a bullish change of character. This is what we call a Wyckoff story. A Wyckoff story develops on the chart from the left to the right. So you could see how from the distribution to the downtrend, we are going into the consolidation environment, trading range, where selling is getting exhausted and buying is emerging, suggesting that we might reverse the bias, and then that is being confirmed by the bullish change of character on the minor sign of strength and on the minor backup action. So then what is the only logical deduction on the continuation that we might have here? Continuation to the upside. There is nothing left. I mean, if the selling is exhausted, if the buying is present, if then buying overwhelms selling and now goes into the structural change, we're going higher from here. And then we could talk about, the character with which the price might go up, the potential areas of where the price will go to, and so on and so forth, and see what happens next. We're producing first a shakeout, and this was a news-driven day, so we're not going to talk about this. This is a specific topic for us to cover later on. But, after this shakeout, the price resumes the initial bias that was associated with the causality through this whole formation. And now we have a much more aggressive major sign of strength and a major backup action. Okay, well, let's make observations about that. So if we would be talking about a major sign of strength, what could you say about this? Does the effort to the upside expands or decreases? Definitely expands, and a lot, right? So we see how the volume signature is becomes almost abnormality for the session that we have here. This is the highest volume signature, so this is significant. Okay, how about the upward result? Definitely expansion as well, and very aggressive too. Bullish or bearish? Definitely bullish. Okay, now let's go to a major back-end up action. Okay, we have a move to the downside on the consistent supply. We can't really compare that to the previous supply. It's just not fair. So we will have to compare it to the demand. Is it a supply dominant or demand dominant environment? Definitely demand is in control. Even though supply has increased relative to the previous supply signature, but we know that it's on news. So you're going to have naturally increase in the volume signature. And where do we land? What is the result of that downward action? We are stopping at 1/2 of the rally. And then we are recovering from there. Bullish or bearish? Definitely bullish. So bullish rally, bullish reaction. What is the expectation after this? Continuation to the downside. I'm sorry, continuation to the upside. And that's it. That's how simple it was with these data points and all of the observations that we made. And then we brought more complexity to this. But in reality, when you do this in a specific way, and that is, in a very systematic way of how you observe the data on the chart and how you make your conclusions, deductions about what you're seeing in the context, of the whole Wyckoff structure, it becomes much, much easier and it's much more visible. But, you know, you might say like, oh, I'm excited. This is great. I want to learn how to do this. I want to practice how to do this. Now, again, remember what I told you. Knowledge does not equate skill. What we're going to do in this class is we're going to develop your ability to observe a lot of data points, observe the ones that have more relevance to us, and we will develop the ability also to deduce what those observations based on our knowledge of the Wyckoff methodology actually produce to us in terms of the final conclusion, what's going to happen next. And even that is still just a higher probability, but not a 100%, deduction of what's going to happen. We're going to make some mistakes, but we're going to be better. We're going to be much, much better as analysts and traders. And even after that, I mean, like, let me just, make a side note here. Even when you go through this class and you've, let's say, repeated it multiple times, and I have some other things for you to do on your own that you could do that you will improve, like your mechanics and your understanding, you will increase your skill level and so on and so forth. Even after that, you still need certain things to be worked on and to do in order for you to trade successfully and consistently. I'm talking about, the process, I'm talking about the mindset, and so on and so forth. This is something that is the step after this. And I'm not going to go into the details of that, but I just want to mention this, that there is more to trading after this. But this is where we are. And with that, this is where we're going to be for the whole semester. So let's start this work. And our work is going to be done in multiple ways. One of the exercises that is going to be consistent week to week to week to week is the bias game. And we'll talk about the bias game. And again, I told you, like, I'm going to give you a specific algorithm of how to analyze the chart. You're going to be doing this exercise on a weekly basis. And it's completely free on our website. But the uniqueness of this class in the way how we look at the bias game is that we dissect each bias game, as to what is it that, we have done and what is it that we have not seen and what needs correction. So from week to week, we're going to make those corrections, and it's going to start correcting the way how you think about the analysis, starts correcting the way how you actually conduct your analysis, and so on and so forth. So with that, and we have probably time only for one bias games, let's go through one. Well, before that, for those of you who are new to our community, play the bias game on Twitter. We have the assignment slide for you with no labeling, with nothing on the chart, no names, sometimes no data, time data points or price points, just the price structure and volume, and you have to do your analysis and then vote. And you could see the social media, Twitter vote as to what the community is thinking this bias is for this trading edge. And then in a couple of days, we have a solution that comes out, and there you have our Wyckoff story, which I would absolutely would love you to read through, think through, and just ask certain questions as to where I was making any type of analytical mistakes and so on and so forth. And then look through the labeling, look through our remarks. That would be your weekly, type of work that, we would love you to do. You could also go to our website, wyckoffanalytics.com, and all of the bias games, all of them are there. And you could do the same thing. We've created this page in such a way where you could print out the chart, analyze it. Then you could go to the solution mode and you could look at what the community has decided that was, and then the actual answer with, again, our Wyckoff story, labeling, and all of the descriptions on the chart. extremely valuable exercise, and it's free. So do that on your own, or come to us to the practicum class and do it together with us in each class. So here is our bias game number 118. And I'm going to conduct this with you guys in the same way as I would do in each class. So for those of you who are alumni, most likely over the holiday period, I hope that you were still doing your bias games. Anybody has done those? Just say yes. While you're answering, Masood is asking, Ramon, how many technical mistakes you have had during last year or years before? Wow, a lot, a lot. Yeah, most definitely. And you have to differentiate your analytical mistakes from executional mistakes, right? Or from mindset mistakes. You might be, absolutely correct in your analysis. And I think that my analysis is much, much better than my execution. So predominantly my mistakes are more on the execution side, but there are some analytical mistakes as well. I still yet to find the trader who is so consistent, from year to year to year to year, or from month to month to month to month, from day to day to day to day, from trade to trade to trade to trade. Usually, and I've done this myself, where let's say in the past I've had, some draw ups where I have like 20 plus trades that are all profitable trades. I've done that. You create months and months of profitability, going from 1 month to to another month. That has been done. You could have, a significant return for the year. Especially if you're trading speculative assets like options, or you're trading like cryptos on leverage. So there you have like astronomical results that expand beyond 100, 200, 300, 500%, and even more. But you're still gonna make mistakes, and it's there are a lot of factors that goes into why you're making those mistakes. That's a very interesting topic for me to discuss. So we could most definitely do this, during the sessions. As students in this class, you guys are eligible to ask any questions, practically about anything, but preferably about what we're doing in the classrooms, at any point in any class. So it's not WTC1 where I need to give you this content and we are pressed on time. We are more thoughtful, more deliberate, and we pause a lot, which I like. So sometimes we could spend a lot of time on a single exercise, but it's meaningful. And this is how I want it to be, as a teacher, as a trader that I am, as a kind of like a person that I am. Everything should be deliberate. Everything should be meaningful and thoughtful. Especially when we study. Okay. So what else? Okay, yeah. So quite a few of you have done this. Well, thank you, Masood. Quite a few went through this bias game. So what was the major problem with this bias game? For those of you who have done it. What is that one thing that maybe kind of spooked you? The lack of rally in phase D from Joe. That's a really great observation. Let's just start with that, right? So if we look at the trading range, and we would assume that there is some kind of sprint action here with the test, local test. So if this is a sprint and a test, and I mean, look how the price recovers really quickly, right? So this could be like just one flashcard idea that we have that could solve this whole problem, that could solve this whole bias. a sprint and a test just because of how the price quickly went down and quickly recovered. So flashcard number one. But what happens afterwards? We are going into the next mini trading range, and that is, if this is a sprint and a test phase C, then this whole thing is phase D. And we are in the middle of a much larger trading range, and we are in the mini structure in a sub trading range, which in itself needs to be identified for the bias that it is, right? So what is the bias in this latest trading range? If you would just look at that trading range, what is the bias of that trading range? If you could solve that, you basically have solved the whole puzzle. Okay, well, let's think about this smaller trading range. Let me just clean this up. What is the most important bar in this trading range? Who could tell me? What is the most important bar in this trading range, in this latest mini trading range? Joe is correct again. The first bar. Riley is also saying the first bar. Up bar at the start, Michael is saying. Okay. This is the most important bar. You guys are correct. Why is this an important bar? Let's develop this a little bit deeper. Why is this the most important bar? It sets the boundaries, sets the trading range values, okay? Most result, breakout commitment, value, okay. Yeah, so look how the price is contained within the body of the spread. We do not go below this. We do not commit below this bar. There is an attempt, like a small sprint right here, but we don't have any commitments below the low of this bar. Is it bullish or bearish? No downward commitments below the significant bar. Low. Definitely bullish. Okay. We've talked about the sprint really quickly. So what kind of sprint is this? Number one, number two, number three. Number three. So number three sprint is low volume and no commitment to the downside, instant recovery back. Okay, sprint number three, bullish or bearish? Bullish. Okay. What about the up thrust action here? The way how it commits, it's not just a temporary, like a supply tail commitment, right? We have progressive closes above the resistance. 1, 2, 3. And it's above the significant buy and climax bar. And a high. Yeah, absolutely. So up thrust action, extension. Bullish or bearish? Definitely bullish. Okay, what else could we say? After this up thrust action, the most damaging reaction to the downside, what kind of downward result is being achieved? Is there a sign of weakness that commits, that shows the commitment to the downside? No commitment. So downward result is diminishing from the intentionality point of view. And then we go into the testing. So bullish or bearish? Okay, bullish as well. So based on these observations, is this trading range bullish or bearish? Definitely bullish. And once you solve this problem, now you could kind of line up all our other observations and deductions, to that. We said that in a much larger structure, which this is, we have phase C with the spring, so that's confirmation of that. What about phase B? What could we say about phase B behavior? Strength or weakness? Definitely strength. So the background is uptrend, downtrend, stop in action, automatic rally, secondary test, phase A, then up thrust action, trading range in phase B, sprint test, and phase D just has a trading range. And that's it. There is nothing else to that. So what is the bias here for the overall trading range? Definitely bullish, definitely up. And here it is. Applied materials, the price after that started to go up. And there is some kind of apex formation right here. So we see that the character of the resolution on the rally after the apex is correct. So the minor shallow reactions, there is not a lot of demand or supply at the same time. So just the character of the uptrending environment after the apex. And here it is. Okay, that's it. And again, I could say, look how easy it was, right? When you know what observations will lead you to the specific conclusions, that are going to be relevant to your analysis, well, then right away you could pick up just one or two or three observation points and that are going to be extremely relevant, significant. But you have to know what those are specifically, right? And you need to train your eye to see them, to recognize them on the chart. If you don't, or if you recognize those incorrectly, then most definitely your analysis is going to suffer. Okay, so let's see a couple of questions here. And by the way, guys, I think this is going to be it. After this bias game, we're just going to answer general questions that you have. So make sure that if you have a question, write those down, and I'll go through those into the end of the session, and then we'll adjourn. I'll talk about the whole homework again for our students. A couple of questions here. Phase D trading range at the bottom shows weakness or not? There is only one point of weakness, which is the reaction. This is the weakest reaction in the small trading range. But what is the downward result of that reaction? So that we would judge the result by the ability of the reaction to commit to the downside. So therefore, what kind of result do we have? The downward result is actually diminishing because we're not committing to the downside. So even though weakness has developed, it didn't produce a significant downward result. Therefore, bullish. Is October 13th a sign of strength bar or a breakout or both? October 13th. Which one? Which one, Eden? Okay. So here is 13th, 2013 in phase D. Okay, well, you have to give me, this breakout. Yeah, this is a minor sign of strength as an upthrust action. That's how we would label this. So when we say this, we would know that within the construct of this mini trading range, we are going to have the rally that's going to overcome the resistance. And because this is an upthrust action, this is a reaccumulation. Okay, so what, a different one? 2012, October. Okay, so here, this one. Yeah, this is a local breakout bar, and this is also a sign of strength bar. That's correct. This is going to be one of our points of entry. Okay. So what else? Okay, Lena, let's talk about the Russell in other classes. So what I would urge you to do, Lena, is just to email me the chart with this question and show me exactly on the chart, what you're looking at. And in the next class, I'll answer that question. What is the exact difference between the terms of rally and trend and the reaction? What's the exact difference? Masood, not understanding the question. What's the exact difference between terms of rally and trend and the reaction? Could you rephrase that, please? Okay, another question. Professor Ramon, I have a question for this chart. My mistake is that this looks like a TP formation with only going back up half of the buying climax rally, decreasing volume for the trading range after buying climax, decreasing demand and supply. How do you think it is not a TP? Maybe the proportion is not like TP. Okay, so where do we see the TP formation on this chart? Most definitely as a distributional structure right here. So we could see, even though this is a monthly chart, but we could see how the initial change of behavior was violent, and then all of the attempts to go up failed. That produced the apex formation, and then the resolution out of that. So this is the only TP formation that I could see here. You could make an argument that there is maybe like a TP formation right here. There is nothing else that I see as a TP formation. Now, you could be thinking about reverse TP formation, because usually when we discuss the TP formation, we usually talk about distributional TP formation. Here we have a bullish TP formation, which is the reversed TP formation, right? So we have the local selling climax, then we have a change of behavior, and then after that, all of the attempts to go and retest the support fail. So that's the reversed one. Okay, and this is about another chart. Okay. Previous 4-bar analysis, could this 4 bars occur after the buying climax? Those 4 bars were a part of the S&P and were the end of the reaction. So they did not occur right after the buying climax, that they occurred after the reaction has developed to the downside. Okay, I hope that this helps. If not, then we could discuss this more in the next classes. You just have to show me the chart. Okay, without having benefit of hindsight, where would you enter this trade on the long side? Meaning, when would you have enough conviction this would be a good swing or long-term trade on the long side? I think that and we would have to contextualize this. Obviously, this is 2009 low. So if this particular asset is outperforming at the time, all of this could be a really good point of entry. I think that right here we have also a point of entry, and I'm talking about long-term campaigns, and then any recovery from here also would be a point of entry. Now, this is a monthly chart, so I mean, like, this is a campaign chart. If we are at swing traders, then we would be considering swings like this, for us to trade, and there will be multiple opportunities here and there, and also to the downside as well. The tactics would change for different time frames. Okay. Okay. So I think that's it in terms of the questions for this bar. If somebody wants to start from zero level of knowledge, what do you prefer? You mean in terms of where to start, Masood? I mean, you could start with the basic charting course that we have. This is our way of looking at the technical analysis and Wyckoff concepts and kind of like, merging them together. if you're a complete beginner. If you are familiar with technical analysis, WTC1, which is our flagship course, this is where usually people start. This is 15 sessions on Mondays for each semester, and this is where you start. Then you go to the WTC2 class, which is the practicum skill building, and then after that you go into more advanced tape reading studies. So that's usually the path for all of the flagship courses that we have. Having said this, there are some specialty courses that you could do even after the third level that I would advise to specific people for their specific needs. So somebody might say like, okay, well, I want to study, the horizontal targets, then you will have to take the PNF courses. Or I want to study like, technical analysis tools and Wyckoff methodology combined, then you're going to be taking, other specials and so on and so forth. So there is a path, for different type of knowledge and skill that you want to develop. Okay, so what other questions do you guys have? Because we're at the end of the session. Are you going to talk about how to manage trades over different time frames? Yes, from Julian. Yeah, absolutely. So I think that it's probably not going to be, just to be completely honest, it's not going to be like my focus to, talk about the differences of trading in the specific time frames. But through the questioning that usually students get to me for each class, each session, there are questions where, let's say, somebody brings up, ES futures, 5-minute chart, and we would discuss the lower time frame trading, the analysis, and the tactics as well. So that's how we usually discuss it in that time frame. So that's a possibility. But our primary focus in the classroom is going to be about developing the skill on how to conduct the analysis correctly. And that, it doesn't matter really the time frame. It doesn't really matter the asset. Yes, I understand the question. The time frames specificity is important, and then the asset specificity is also important. But still, conceptually, the analysis is going to be all about the same thing: effort versus result, how we make observations, how we make deductions, and so on and so forth. All right, what else? Maybe one more question. If nothing else, this has been a great class. Thank you guys so much for being here. For those of you who is going to be considering joining us for this class, don't forget you have to start at the level 1. So I know that it's a little bit daunting, and you might be thinking like, well, it's like a college degree, and it is. We actually have a certification, in Wyckoff method studies. So you might consider, something like that as well. So with that in mind, thank you so much for being here. I had a blast, and hopefully I will see you. I will see you in the classroom, whether it's WTC1 or WTC2. Let's do this together. If you have any questions, email us. Nancy could answer any of your administrative questions, or if you have any questions about the course itself, or maybe you are asking for some kind of advice as to how to proceed with your studies, then for sure email me at wyckofassociates@gmail.com. I will be glad to answer any of your questions. With that, thank you so much, guys, and until next Tuesday. Bye-bye.